Francois, Savary, good morning. Welcome. Thank you for joining us.
Thank you.
The week ahead, is that going to be a typical quiet Thanksgiving week, in your opinion?
I think, yes, in general, you can say that it's going to be a quiet week. Nevertheless, you have some important numbers coming. The first one being the minutes of the Fed, which will reveal what was the discussion among the Fed members during the meeting where they decide to keep interest rates where they are in the US. And then you have some significant numbers coming for Europe because everybody is expecting a kind of bottom process in Europe, and we will have the PMI indices that are going to be published both in Europe, the UK, even in the US by the end of the week. And in Europe, you will have some other very important indicator like the IFO that is going to be published at the end of the week. So yes, not such a busy week, but nevertheless, some numbers to take a look at.
Nvidia on Tuesday?
Nvidia on Tuesday, very important because Nvidia, as everybody knows, is a company that had a 200% performance this year. Everybody knows that is related to AI, and this is the leader in AI. So very important to see what are the prospects and what were the results for the third quarter.
So interestingly, that brings us quite neatly to semiconductors, which were an all-time high last week, and Microsoft that closed again at a record high. Is this going to be a good indication for what's going to be happening at Nvidia, in your opinion, or not?
I think that it can be yes, but NVIDIA is very specific. You know, it has the GPU and it's completely dependent on that, on the AI. So in general, yes, semiconductors is a key element in what you need to really develop AI. So you can make a connection, but always remember that the semiconductor is kind of cyclical, but it has a special cycle. And that the fact that you had such a run on semiconductor is because you have companies telling you that the inventory process that weigh on semiconductor for many quarters after the COVID-19, it's coming to an end, and that they can see conditions that are improving and demand improving with reduced inventories. So I think that it's a lag effect of the post crisis, health crisis that we are experiencing. But it tells you that technology in general, even Microsoft, you mentioned Microsoft, but Microsoft is a very, very solid company. The numbers that they produce were excellent. And at the end of the day, for the investor, the big question is, do I want to hold tech companies in my portfolio, or do I have to get rid of them because they performed so well in 2023? And I believe that solid technology company still have to be part of a portfolio. Do not get rid of them. Do not believe that they are to my point of view, they are not going to experience a significant correction. They are companies that you want to hold in a portfolio. And I think this is what you need to keep in mind. Technology is still something that you want to have as a theme in your portfolio in 2024. You choose, you be selective, select name, or you go for ETF. I would rather go for specific names than to go through an ETF for the technology company.
Coming to Japan and the yen, there was an article, there was an analysis announced by Bank of America showing that the hedge funds were massive shorts in the yen, biggest shorts for at least a year and a half. Nikkei on its highs. What's your thoughts on that?
I think that the yen is completely undervalued, and there is a moment of reckoning that is going to come for the BOJ. They will have to decide what they want to do with monetary policy. And I think that they could surprise the market by getting rid of the very loose monetary policy that they run for the last few years and get for something that is going to be more neutral. That's the reason why I was very surprised by the fact that the hedge funds have decided to remain very short the yen. I think it's a dangerous bet. If I had to make a choice, I think that the yen is going to appreciate in 2024, and I think that there are opportunities there to take some position.
Coming to some of the inflation numbers last week, so CPI was higher by less than expected, 3.2%. PPI was down quite a lot at 0.5%. What's your thoughts on those?
I think it confirms you that the disinflation process that we were expecting is materializing. And I think that this is a very, very good news, and especially for the bond market, because the bond market has been able to rally on that on those numbers. Equity benefited from that. The big question that you need to have, is it a blip? Is it the end of the process of disinflation? Or are we going to continue towards the 2% target CPI numbers that the Fed has in mind by the end of 2024? To my point of view, what you need to have in mind is make your choice if you consider that the process is going to last and 2% is going to be reached, or do you believe that it's the target at 2% is not reachable in 2024? I believe that from now on, it's going to be much tougher to get inflation down. And especially if you believe that there is some soft landing materializing in the US, which means that there will be no hard landing and that the destruction of demand is going to be limited. I don't believe that you should expect the 2% target reach in 2024.
So, what does that say to us about the stock market then?
The stock market, good question. The stock market, and especially when we are considering this period, which usually brings people to think about what is the prospect for the equity market the year ahead. To my point of view, the potential on the equity market is limited because you have a lot of very, very good news that are priced in the equity market. First of all, the soft landing is very consensual right now. Nobody believes that it can be less than a soft landing. So earnings expectation are quite high, close to double digit. I think around 10% for the S&P 500. The P's are not very cheap, especially in the US. Interest rates have come down. So I believe that the equity market has a potential, but it's not a 20% potential to my point of view in 2024. I think that you need to be reasonable. And when you consider your allocation and the diversification of your portfolio, I think that there is room to have a solid exposure to bond market that will benefit, to my point of view, from lower interest rates by the Fed by the middle of next year. It should support the equity market, but to a limited extent, to my point of view. So equities, yes, you need to have equities. To be neutral equities is logical if you believe in soft landing. The key question that investor needs to have in mind, you know that investors have built huge position in cash. And the big question for them is, what do I do with my cash right now? You know, if you have close to neutral exposure in equities, maybe it's a wise move to try to play the yield curve and put some cash that you have currently to reduce that and put it on the curve to play over time the ability of the bond market to perform quite well also in 2024.
So, to your mind, price earnings of 19 on the S&P for forward earnings, do you think that's a bit overdone?
It's a bit overdone. It's above the average. The number is above average P's that you experience on the S&P 500. Is it ludicrous? I wouldn't say so. Because if you are able to get through a soft landing, and if you have the confirmation, because what is interesting with the end of the earnings season in the US is that for the first time in fourth quarter, you had a growth in EPS that materialized in the third quarter. 4%, which is not that bad, above expectation at the beginning of the season. Many people believe that it is going to continue. And as I said, it's going to be reach double-digit numbers in the next few quarters. What is interesting is it going to materialize or not? If you believe that you can grow between 6 and 10%, I think that 19 is okay. You can live with that. If you are going to grow less than those numbers, then it becomes more difficult to justify a 19 times earnings forward.
Okay, so between soft landing and hard landing, which one are you going for?
I think that in terms of probability, soft landing is the highest probability. Hard landing is a low probability. And you know, for me, it's quite difficult to say that in the sense that, you know, to make a soft landing happen is something that is rare and unusual. So I think that yes, you have to accept that the numbers are telling you that yes, there is a deceleration in economic activity in the US, but it's not something that is significant for the time being. And so soft landing is the highest probability in 2024.
All right. So in the last few weeks, despite the indications from the central banks that we need to be higher for longer, the market is really betting against them, and they have reduced. Well, they brought the expectations forward for rate reductions to almost March, I think, in some
March.
cases. Do you
Yes,
think
but I think
that's too much?
it's excessive. I think it's excessive. Yes, I still believe that it's not going to be before the second quarter and end of second quarter that the Fed is going to lower interest rates. Because again, as I said, inflation came down quite a lot over the course of the last 12 months. And now the period of disinflation is going to be tougher. Do not expect that, to my point of view, that you will see inflation getting towards the 2% target of the Fed very quickly. It's going to be a slow process, and I believe that's the reason why the Fed is going to be cautious in getting interest rate down, at least in the first half of the year. And moreover, as I said, you have some less positive condition on the labor market, but you cannot, for the time being, justify the idea that there is a crash on the labor market that should justify a very quick action by the Fed. So the two numbers that you mentioned, CPI and jobless claims, are numbers that are not telling you that there is a need for a very quick decrease in interest rates.
All right. If interest rates expectations are increasingly positive in the sense that they would be reducing sooner than even the most optimistic people thought. What does that say about the gold market? How's that going to affect the gold market?
I think that the gold market is going to benefit from that. I think that it's going to be a major beneficiary of the environments that the interest rate environment that we are going to experience in 2024. And again, I come back to if the market is right about the interest rates coming down in March, you should ask yourself, what does it mean in terms of economic activity? What does it mean in terms of equity market? What does it mean in terms of volatility for equity, for risk assets and high yield equities in the next 6 months? It tells you that you will have a lot of volatility. It tells you that interest rates are going to come down, that equities are not going to have conditions that are very supportive, and gold is a very good diversifier in such an environment.
How high do you think it can go if that is confirmed with lower interest rates, environment, etc.?
Short term, it can go above 2000. That's clear. The big question that you have medium to long term is also supportive to my point of view for gold, because you have this increase in indebtedness that is all around the world. And I think that as a substitute, medium to long term, gold is very interesting. And that's the reason why short and medium term, I am positive. Above 2000, going to 2050 in the coming months is possible with lower interest rates. And then in the second phase, the gold price can go push higher because government will have to deal with this issue of indebtedness that is reducing the attraction of currencies. And I think that gold is going to benefit from that in the medium to long run.
Francois Savary, it's been lovely to be talking to you again. We'll see you next Monday. Bye bye.
Thank you. Bye bye.